Good morning to you both. Liz Ann, I guess the question is always what's priced in, is it enough, right? We have the market basically pricing in 2.5 percentage points of Fed rate hikes right now. Very much a pre-recessionary look to sector leadership going on right here. Where does that leave us as the S&P sort of tests the lows for the year?
Oh, I think I suppose a soft landing, you could argue, is priced in. I don't think a recession is priced in. I think what's maybe even more interesting than the latest market action was what was happening in the 3 weeks or so from the March 8th low in the S&P up until the March 29th high. Is leadership was decidedly low quality, well down the spectrum into negative earnings companies. Signs of a lot of short covering. The cyclical industries underperformed. So even during that rally phase, I think it was sending a weak economy message, only reinforced by the move down more recently. So soft landing, yes. Recession, no.
So how narrow, Liz Ann, do you think the path is to a soft landing that maybe the market is using as its premise right now?
I think fairly narrow, but keep in mind of the prior 13 rate hiking cycles, we've had 10 recessions and 3 soft landings. So a recession should always be a higher likelihood outcome, especially now when you have a Fed tightening into a slow economy, up off the zero bound, simultaneously trying to shrink a $9 trillion balance sheet with inflation at a 40-year high and a pandemic still going on and a war in Europe. I'm not sure if that moves the needle to one or the other, how it's easy to argue that it moves it more towards soft landing. That doesn't mean it's not possible. We could see inflation roll over through some of its own forces, financial conditions tighten enough that it slows growth enough, and the Fed maybe later in the year doesn't have to be as aggressive. But I think recession in a tightening cycle is always the more likely outcome.
David, today it's all about China. If you look at what is weakest in the market, it's everything tied to a China growth story slowdown, from energy to commodities to an Apple or a Tesla or even a Microsoft. So how do we add that risk into the equation with a global economy that's already slowing on sky-high inflation, tightening monetary policy, a war in Ukraine?
So I want to latch on to something that Liz Ann said at the end there, which is effectively the Fed isn't going to be able to do this by itself. You know, when investors look around in the current environment, they just don't like what they see. They see slower growth in China. They see the rapid spread of Omicron. In our own backyard, they see a Fed that is getting increasingly hawkish and looking to raise rates aggressively at the next couple of meetings. And so, you know, I think investors need to recognize that they can't have all good things, and slower growth, to the point that was made earlier, could actually help us thread this inflation needle and allow the Fed to take their foot off the monetary brake later on this year. But I think these cross currents are just causing a lot of uncertainty, and that's why markets are under so much pressure.
So a question for both of you, but I'll start with you, David. I mean, given all of these uncertainties, how does an investor put their money to work right now? Is it in equities? Is it somewhere else?
So we still see opportunity in equities. You know, the sell-off in things like the NASDAQ, we think, has created some opportunity, particularly in those more profitable parts of the growth complex. But, you know, we're also seeing interesting things in value. Value companies have much more operating leverage than their growthier counterparts. And so to us, it's really an approach of price to earnings growth more than anything else.
Shepard Smith here. Thanks for watching CNBC on YouTube.